Good evening, everybody. Welcome back. So we are actually going to start off the last day of this P4 question-based revision session for June 2018 examination. Up till now, what have we actually gone through is uh, we've actually gone through risk management, and we did also go through one of the questions on the restructuring, which was about the financial reconstruction. So what we are actually going to do now is we are now going to move forward, and the next area that we would actually be focusing upon is going to be another question from the past papers. And the question that I'm actually going to be discussing today is the September-December 2016. September-December 2016, question number 1. September-December 2016, question number 1. Okay, so now let's actually start off with this September-December 2016 question number 1. The question's name is actually Morada Company. It's actually Morada Company. Now let's actually talk about this specific question, which is Morada Company. So as per our discussion in the yesterday's session, somebody actually requested that if I could give a brief overview of the topic before going ahead with the question. So what I'm actually going to do is I'm going to give a brief overview of the topic, and then I'm going to move forward. So if I actually talk about this Morada Company question, the question Morada Company has got several question requirements. So first of all, what I'm actually going to do is I'm going to open up the question requirement and would explain to you that what exactly is the area. Okay, so let's actually talk about this Morada Company, that what is this Morada Company question all about. So the question actually is, it says briefly explain how business risk and financial risk are related, and how risk mitigation and risk diversification can form part of company's risk management strategy. So the question actually focuses upon what is the business risk and the financial risk, how are they related to each other, and you need to explain how risk mitigation and risk diversification can form part of the company's risk management strategy. Now what next? Next situation is, it says prepare a report for the board of directors which estimates Morada's cost of equity and cost of capital based on market value of equity and debt before any changes, and then after implementing the proposal put forward by the first and by the second directors. By the first and by the second directors, estimates the impact of the first and the second director proposals on the forecast after tax earning and forecast financial position for coming year, and discusses the impact on Morada Company of the changes proposed by first and second directors, and recommend whether or not proposal should be accepted. The discussion should be so and so. Lastly, it says discuss possible reason for the third director's proposal that a risk management system should consider each risk before taking appropriate action. Now, so what I'm actually going to do is I'm going to have a quick discussion about the areas of risk management. So I'm actually going to write down few things, and then I will discuss on those specific aspects. Okay. Uh, so okay. Now let's talk about this concept of business risk and the financial risk. So basically, the requirement of the question is about the business risk and the financial risk. So I'm actually going to give a brief background of what a business risk is and what a financial risk is. Now you see, what happens is whenever we calculate the cost of equity of an entity, the cost of equity of the entity is actually determined using multiple methods, and the multiple methods are basically the multiple methods that actually can be used is the dividend valuation model and the capital asset pricing model. These are the multiple methods that can actually be used. Now, if I actually talk about these methods, that when can these methods be used? Okay, so basically what happens is the capital asset pricing model has a formula which is the cost of equity, the risk-free rate of return, plus the equity beta, multiplied by the market rate of return minus the risk-free rate of return. So if I could actually have a general discussion about what exactly a beta reflects. So the beta actually reflects the risk, and the betas are actually of three types. And what are those three types of beta? One of them is equity beta, the other one of them is debt beta, and the third one of them is asset beta. Now, what's an asset beta? What is the debt beta? And what is the equity beta? So basically, the asset beta is actually a beta which reflects the business risk. Now, what exactly do you mean by the business risk? So the business risk actually is a risk associated with the business. Generally speaking, that a business which is operating in a competitive environment, that's actually a business risk, that the competition would actually wipe you off. The competition would give you a tough time, that could be a business risk. In addition to this, there could actually be high fixed costs, that might also be the business risk. At the same time, your volatility of the cash flows, that could also be the business risk. The external environment, the political, economic, socio, and other factors which could have an adverse impact on the business, they're all business risks. So what is a business risk? A business risk is generally that the business will not be able to achieve its objective. So generally speaking, the business risk is indicated by these factors. And what exactly is a financial risk? A financial risk is actually a risk associated with the financing of the business. Now, what happens is when we actually obtain debt finance, so we are actually facing a risk. What is that risk? That even if we are not able to earn the cash flow, we will still have to make payment to the we'll still have to make payment to the debt providers. In addition to this, when we talk about the debt, so we also have other risks that the overall slight volatility of the cash flow might actually lead to default in the payments, and there may actually be the case that the lenders may actually um, come for immediate repayment of the funds, etc. There could be a lot of things. So the first thing is basically when we talk about it. So the first thing is actually the business risk. Is the risk that the business will not be able to achieve its objective, and those risks actually arise because of the business environment, because of the external environment, etc. Financial risk is mainly associated with the financing of the business, mainly associated that a business may not be able to meet its debt obligations, etc. Now, and what exactly is equity? What exactly is an equity beta? So, equity beta is a beta that actually reflects both the business plus the financial risk. So, generally speaking, what happens is equity beta, debt beta, and asset beta, they are connected to each other. Now, the next thing, there's actually something which is called portfolio theory. There's actually something which is called portfolio theory. Now, what exactly is the portfolio theory? Portfolio refers to investments. Portfolio refers to investments. So the investments that we make is actually considered as portfolio. The investments that we make is generally referred to as portfolio. Now, let's talk about the portfolio. So portfolio actually refers to the investments, and generally speaking, what does the portfolio theory suggest? The portfolio theory generally suggests that portfolio theory generally suggests that an investor would want to diversify its risk. The investor would want to diversify his risk. What he would do is that he would want to diversify his risk. Now, if the investor would want to diversify his risk, so generally what happens is, in order to diversify the risk, the investor generally creates a portfolio. So what happens is, the portfolio, when they are created, so the risk actually gets diversified to an extent, and there would still be, no matter whatever the number of portfolios that you will create, there would still be some risk, and that's going to be left. So that risk is actually termed as systematic risk. And the risk which was actually diversified away, it's an unsystematic risk. So this systematic risk is actually referred to as equity beta, the one which could not be diversified away. It reflects both the business plus the financial risk that is being faced by the entity. So if the question's requirement is actually about how business risk and financial risk are related, so business risk and financial risk are related through this formula also, which is asset beta is equivalent to equity beta multiplied by E upon E plus D 1 minus T plus debt beta into D1 minus T divided by E plus D1 minus T. So generally, if we talk about the asset beta, that's how the asset beta is. It's actually equity beta into E upon E plus D1 minus T plus BD debt beta 1 minus T. So that's how generally the relationship is. And we've actually understood the concept of portfolio theory. We've understood the concept of systematic and systematic risk. So you need to explain how business risk and then how risk mitigation and risk diversification can form part of company's risk management strategy. So generally speaking, the risk diversification does form part of the company's risk management strategy. How? Because whenever a company faces a risk, the company usually creates portfolios. So by creation of the portfolio, the risk is usually diversified away. So the risk diversification is generally part and parcel of the company's risk diversification strategy, risk management strategy. And in addition to this, the risk mitigation, which could be the use of hedging techniques, which could be the use of derivatives, etc. They could be part of the risk management strategy also. Why? Because through this, what would happen is that the company would be able to reduce its risk, because every company tries to ensure that they don't actually carry a lot of risk. Now, what is the next requirement? It says prepare a report for the board of directors which estimate the Muhammad Adim, we are attempting December 2016, question number 1. The next situation is prepare a report for the board of directors of Morada company, which estimates Morada's cost of capital based on market value of debt and equity before any changes and after implementing the proposal. So what you need to do is that you need to calculate that what is exactly going to happen with the cost of equity and the cost of capital after the changes that are being suggested by the directors have been incorporated. So let's go through the question first and then we can have a quick discussion on this. Okay, so let's actually discuss this question. Now the question is basically, it says Morada company is involved in offering bespoke travel services and maintenance services. In addition to owning a few hotels, it has built a strong relationships with companies in hospitality industry all over the world. It has a good reputation of offering unique high quality holiday packages at reasonable cost for its client. The strong relationship has also enabled it to offer repair and maintenance services to a number of hotel chains and cruise ship companies. So what is their business? Their business is basically, uh, they are offering bespoke travel services and maintenance services in addition to owning a few good hotels. Um, they've got relationship with companies all over the world, etc. Now, following a long discussion at meeting of the board about the future strategic direction which Murata should follow, three directors continued to discuss one particular issue over dinner. In meeting, BOD had expressed concern that Murata was exposed to excessive risk and therefore its cost of capital was too high. BOD feared that several good projects had been rejected over the previous 2 years because they did not meet Murata's high cost of capital threshold. Remember one thing, the higher the discount rate, the lower the NPV is going to be. And obviously, if the NPV is going to be low, you are obviously going to reject the project. So it says that higher discount rate, basically the current high cost of capital, has resulted in Morada rejecting a lot of projects. So obviously, this is actually going to happen. Now, what next? Next situation is, it says, first director's proposal. It says the first director is of the opinion that Morada should reduce its debt in order to mitigate its risk. Now what it says is that he says that they should reduce their debt in order to mitigate the risk and therefore reduce its cost of capital. He proposes that company should sell its repair and maintenance service business unit and just focus on offering bespoke travel services and hotel. In the sale, the book value of non-current asset will reduce by 30% and the book value of current liability will reduce by 10%. It is thought that non-current asset can be sold for an after-tax profit of 15%. So this is what they expect. They expect that you can sell this division of repair and maintenance, and you can actually get good amount out of it. Now, first director suggests that fundraising from the sale of the repair and maintenance business unit and cash resources should be used to pay off 80% of the long-term debt. It is estimated that as a result of this, Murada's credit rating will improve from Baa2 to A2. So that's what the first director's proposal is. What is the examiner asking us to do? The examiner is actually asking us to do that the examiner wants that we should calculate Morada's cost of equity and cost of capital before any changes and after implementing the proposal put forward by the first and by the second directors. So that's what they want us to do. So we would have to actually perform three calculations. One of them is going to be for the existing cost of capital, and the other one of them is going to be for the revised cost of capital under director one's proposal and revised cost of capital and the cost of equity under director two's proposals. Now, पानी दे दे, ये बहुत छोटी है, थोड़ी बड़ी बोतल. सही है इंशाल्लाह. सलाम अलैकुम. Okay, now what next? So what we actually need to do now is, first of all, we will calculate the existing details and then we can move forward. So you actually have this Morada company's extract from the forecast financial position. So we do have this balance sheet, etc. And in the balance sheet, we do have this share capital, which is of 40 cents. The non-current liability includes 6.2% redeemable bonds. Let's move forward. Other financial information. Now, what is this other financial information? Let's talk. It says Murada Company's forecast after-tax earnings for the coming year are expected to be 28 million. So the after-tax earnings, the profit after tax is going to be $28 million. It is estimated that company will make a 9% after-tax return on any new investments. and will suffer a 9% decrease in after-tax earnings on any reduction in investment in non-current assets. Now, the company's current share price is 2.88 according to company's finance division. It's very difficult to predict how share price will react to either proposal. Therefore, it's been assumed that share price will not change. Now, it says the finance division has further assumed that proportion of the book value of non-current assets invested in each business unit gives a fair presentation of the size of each business unit within Morada. The equity beta of the company is estimated to be 1.2, while the asset beta of the repair and maintenance service business is estimated to be 0.65. It says the relevant equity beta for the new larger company, including the construction unit, relevant to the second director, has been estimated as 1.21. The bonds are redeemable in 4 years' time at face value. For purpose of estimating cost of capital, it can be assumed that debt beta is 0. However, 4-year credit is spread over the risk-free rate is 60 basis points for A2 rated bond, 90 for Baa2, and 240 for CA3. Tax rate is 20%, the risk-free rate is 3.8, and the market risk premium is 7%. Now, what exactly is going to happen? First of all, we would have to calculate the existing cost of equity and the existing weighted average cost of capital. We have to calculate the existing cost of equity and the existing weighted average cost of capital. So when we talk about the existing cost of equity, the cost of equity is risk-free rate of return plus equity beta multiplied by RM minus RF. So you have got the risk-free rate of return. And how much is that risk-free rate of return? So the risk-free rate of return is actually 3.8%. It's actually 3.8% plus the present equity beta of the Morada company is 1.2. The market rate of return is basically not given, but they've given the market risk premium, which is actually 7%. So market risk premium is RM minus RF. So how much is the current cost of equity? Can you please calculate? %12.2%. Okay, so the first thing for the weighted average cost of capital calculation is the cost of equity, which we have got. Now, what else do we need? For the WACC, we need the market value of equity. So how would we calculate the market value of equity? So you could see from the company's balance sheet that the company has $50,000 capital and 40 cent share. So it's actually 50,000 divided by 0.4. So gives you 125,000 shares. Each share is presently trading at how much? How much is each share trading at? So it says that each share is currently trading at 2.88. Okay, it's 2.88. So what is the market value of equity? Okay, 360,000. Okay, let's talk about the market value of debt. So value of debt is actually present value of future cash flow discounted using market rate. Now if we talk about it, so what exactly are we going to do? So we are going to say that the company's current credit rating, the current credit rating of the company is right now, you can see in the first director's proposal that the company's current credit rating is Baa2. Baa2. So for the current credit rating, the question actually says in the last paragraph that for the current credit rating, what do we have? We have got the relevant cost of debt is risk-free rate of return plus 0.9%. So the risk-free rate of return is actually 3.8%. So it's 3.8 plus 0.9% gives you how much? 4.7%. Now, so if you need to calculate the value of the debt which is actually 4 years debt is redeemable in 4 years at its face value. So let's actually talk about the value of the debt. So we would say that year, you would say cash flow, discount factor, and then the present value. So year 1, year 2, year 3, year 4. So if we talk about the discount factors year 1, 2, 3, 4. So what is actually going to happen? You have got a 6.2% redeemable bond. It's actually 6.2. 6.2 and you have a discount rate of 4.7%. So can somebody please calculate the market value of debt? Okay, so it's 9.55%. 95? No. One of 5.4. Okay. So now what you could do is that you could calculate the WACC because the KE that we have is 12.2%. Multiply by market value of equity is 360,000. In fact, the total market value of debt is 120,000 divided by 100 into 105.4. 'Okay, and how much is the WACC? Okay, I'm waiting for your answer. I've got one answer at 10%. Can anyone else please confirm? Okay. 10.25, 10.67. Why is there such a variation? Okay, approximately 10%. Okay, now what next? So we've actually attempted one requirement, and one of the requirement was basically that we were supposed to calculate the existing cost of equity and the existing weighted average cost of capital. Now it says now you need to calculate it after implementing the proposal. Now whose proposal? Director 1 and Director 2. So first of all, we are going to focus upon Director 1's proposal. That what was his proposal? His proposal is that we should reduce the debt by selling the repair and maintenance service business unit. And his point is basically that the book value of non-current asset will reduce by 30%, and the book value of the current liabilities and the book value of the current liabilities You'll have to wait for a minute. I need to get some equipment fixed. I think there is some issue with the equipment. Just wait for a minute. Okay, so we did actually go through the calculation of the existing weighted average cost of capital. Now we need to do what we need to do is that we need to calculate the WACC and the cost of equity after the implementation of the first director's proposal. If you look at it, what is actually happening in the first director's proposal? He says that repair and maintenance services business unit should be disposed of. Okay, so this company, which is right now having two businesses, the Morada company has got two businesses. Now, what two businesses are there? These two businesses are actually, one of them is repair and maintenance business, and the other business is basically travel services. Now, what actually happens is you need to understand one thing. First of all, we have got the equity beta. Of this Morada company. The equity beta of the Morada company that we have is actually 1.2. It's 1.2. The equity beta that we have is 1.2. Now what next? Next situation is, okay, sorry. Okay, so the next situation that we have is 1.2 is the equity beta of this whole business. Now see, this business is made up of repair and maintenance and the bespoke travel services. What the question actually tells us is that in this part of the question, they actually told us that the finance division has further assumed that proportion of the book value of the assets invested in each business gives a fair presentation of each business unit within the Morada company. So we were actually being told that 30% of the non-current assets would actually be sold. So basically, this repair and maintenance constitutes 30%, this constitutes 70%. Now, one thing that you need to understand is the business risk plus the financial risk gives you equity beta. One thing that you need to understand is business risk plus financial risk gives you equity beta. So basically what happens is the asset beta, when we incorporate the gearing effect in it, we end up getting the equity beta. Now, if a business is like a business of Morada company, which actually has got two segments, so what is going to happen is that this asset beta of repair and maintenance multiplied by 30% plus asset beta of travel services multiplied by 70%. This in total would actually give you asset beta of Morada company. And Morada company's asset beta at the gearing level of Morada will give you equity beta of Morada company. So over here in this specific question, we are being given Morada company's equity beta, and we are also being given the asset beta of one of the segments. And what is that one of the segments whose asset beta we have been given? That's a repair and maintenance service. Now, so we have been given the asset beta of the repair and maintenance service business. Now what next? Next situation is that first of all, what we would do is that we would convert the equity beta of Morada company. We would convert the equity beta of Morada company into its asset beta. How would we do it? We would say asset beta is equivalent to equity beta multiplied by E upon E plus D 1 minus T. So you've got the asset beta as 1.2 multiplied by 360,000 divided by 360,000 plus the debt, which actually had a value of, how much was the debt's value? It had a value of what, 120 million? 126,400. So how much is the asset beta? 480. Yeah, 1 minus 3. How much is the asset beta? 0.94. Okay, so now this 0.94 is the asset beta for Morada company. This asset beta of Morada company is actually made up of 0.65 into 30% plus x into 70%. So this 0.94 is equivalent to 0.65 into 30% plus 70% or 0.7x or 0.7x. So what is the value of x? 1.06. So basically the bespoke travel services business has got a business risk of 1.06 and the repair and maintenance business had a business risk of 0.65. Now what is exactly going to happen? The first director's proposal was that we should actually the first director's proposal was that we should sell the repair and maintenance service business. So if you're going to sell this repair and maintenance service business, what his idea was that we should pay off 80% of the long-term debt. Now, if you're going to pay off 80% of the long-term debt, so what is actually going to happen? The equity value of 360,000 will be unchanged. The debt, which is going to be 80% repaid, so right now it is 120,000. The par value of the debt, which is going to be available now, is going to be 20%, which is 24,000 will be available. So what we need to do is that this is the book value of the debt. So we need to now calculate the market value of the debt. Now, how would we calculate the market value of the debt? Then again, it's actually present value of future cash flow, discounted using market rate. Now, what is going to be your KD? The KD is actually going to be, since the credit rating would enhance, then what exactly is going to be? It is going to be like this. The risk-free rate, which is actually 3.8% plus the credit rating of A2 rated, because the rating would increase, is actually 0.6 the credit spread, 4.4% is going to be the KD. So can you please calculate the market value of the debt by discounting the cash flows of the bond using this 4.4%? What is the value of a $100 bond? Okay, 106.7. So we've got 106.7. So basically the market value of debt is going to be 24,000 divided by 100 into 106.7 gives you how much? 25.6 million. So can you actually calculate the revised WACC? No, we can't. Number one, wait. We need to have the cost of equity also. So we have actually calculated the market value of equity. We have calculated the market value of debt. We do have the KD, but we don't have the KE. So for the KE, you would be needing equity beta, the equity beta for the revised gearing. So we do have equity beta is equivalent to asset beta multiplied by E plus D 1 minus T divided by E. So asset beta is 1.06 multiplied by 360 million plus 25.6 into 0.8 divided by 360. So that's how it is. Can you please confirm how much is it? Okay, so this is 1.12. Now calculate the revised WACC. One of the answer is 11.6. One answer is 11.1. What's the correct answer? 11.26. Okay, so 11.26% is going to be the weighted average cost of capital. Um, Now this is actually the implementation of the first director's proposal, and his proposal was that he suggested that we should actually sell off one of the segments, and we should actually use the funds to pay off 80% of the debt. So out of this, we have got 11.26%. How much was the WACC before? So the WACC before this was 10%. Now it's 11.26%. So the opposite has happened. He was suggesting that we should actually go for repayment of the debt by selling the division. Now, can you understand what has actually happened? Why has the WACC increased? Although the cost of debt has reduced, but why has the WACC increased? Does any one of you understand this? Okay, now the reason for this decline, this increase in the WACC is because before, you see, what is the cost of equity in this given scenario? What's the cost of equity? It's 11 point something percent, right? And what was the cost of equity earlier? It was 12.2%. Okay. Basically, over here, what has actually happened is that the business, that finance is cheaper than equity. Yes, what has happened is debt finance is cheaper than equity. That is one of the things. So earlier, the entity had a higher debt finance, and debt is a cheaper source as compared to equity. Debt has a tax benefit, whereas equity does not have. So although the cost of equity has declined, but overall, the the tax savings, the tax effects of the debt have actually been foregone. So what we are actually going to have is a short prayer break. We are starting back at 7:20 p.m. Okay, so welcome back. Now let's actually continue doing that question which we were on. So this question up till now, what we have done is we have discussed the concept of business risk and financial risk, and we have talked about the risk mitigation and risk diversification. Furthermore, what have we done? We have actually talked about the existing cost of equity and the cost of capital. And also we have actually calculated the revised cost of equity and the cost of capital after implementing director 1's proposal. And now we need to do is that we need to implement director 2's proposal, and we need to calculate the cost of equity and the weighted average cost of capital. Now let's talk about it. So it says the second director it says the second director is of the opinion that risk diversification is the best way to reduce Morada's risk and therefore reduce its cost of capital. He proposes company raises additional funds using debt finance and then create a new SBU. The business unit will focus on construction of new commercial properties. It says second director suggests that 70 million should be borrowed and used to invest in purchasing non-current assets. The new debt will be issued in the form of 4-year bonds paying an annual coupon of 6.2. It's estimated that if this amount of debt is raised, then Morada's credit rating will worsen. So and so the current liabilities are estimated to increase. So and so. Okay. So what we need to do is that we need to see that what is exactly going to happen in the second director's proposal. So in the second director's proposal, what is actually going to happen is market value of equity would remain 360 million. The debt would actually be one of them is basically there are going to be two debts now. One of them is an old debt and the other one of them is a new debt. The new debt would actually be having a market value of 70 million. The new debt would actually be having a market value of 70 million. Old debt has a book value of 120 million. Now what is actually going to happen is the cost of equity has to be calculated, and for that examiner has already given you that the revised equity beta after the second director's proposal is going to be 1.21. So it is actually going to be 3.8% plus 1.21 into 7%. So resultingly, how much is it? 12.27%. 12.27%. The cost of debt is going to be 3.8% plus 2.4%. So the cost of debt is going to be 6.2. Now let's just try to understand one thing. If the coupon rate is equivalent to market interest rate, then the book value of the bond is equivalent to its market value, and that is going to be 120 plus 70 gives you 190. So we have got we have got the market value of equity, we have got the cost of equity, we have got the cost of debt, and we've got the market value of debt also. So can you calculate the revised WACC? Can you calculate the revised WACC? 10.46, 9.8. Why is there a difference? Okay, if coupon rate was different than cost of debt, what would have been one? Tasnua, if the coupon rate was different than the cost of debt, then we would have actually calculated the market value of the debt by discounting the cash flows just like we did previously. Zoeb Ali and Ruth, I'm not able to understand your answer because two people are saying 9.8% and yours answers is over and above 10%. Why? No, you don't need to discount. Why? Because the reason behind that is even if you discount it, it would come out to be 120 million only because the coupon rate is 6.2 and the market rate is also 6.2. Okay, so the WACC is 9.8%. The WACC is 9.8%. So, first of all, you see, this is a very common question. You would see similar type of question in the past examination also, where you are actually being given a scenario where the company undergoes some restructuring and you need to calculate the weighted average cost of capital and the cost of equity before and after the restructuring. So, this is a very common type of a question and you should be well aware about it. So you should actually know that how to de-gear the beta and how to actually re-gear it and how to actually apportion the beta into the various business segments. So you should actually be aware about it. Yes. Obviously, when you will calculate the WACC, you will have to actually discount, you'll have to incorporate the tax because it's going to be 12.27% multiplied by 360 divided by 360 plus 190 plus the KD, which is 6.2% into zero point 0.8 into 190 divided by 360 plus 190. And if that is the case, the first instance is the 10.25%. Uh, well, I have whatever that I have written is I have written KD. I have not written KD 1 minus T. Okay, so basically, up till now, what have we discussed? We have discussed that how the weighted average cost of capital, etc., would be affected. So this is actually 6 plus 17 marks. Now we still left with some good amount of marks in this specific question. It says estimate the impact of the first and the second director's proposal on Morada's forecast after tax earning and forecast financial position for the coming year. So what I would actually want you to do is that to perform a quick calculation that how would there be an impact on EPS. We performed a similar type of question in the yesterday's session also. So can you please actually calculate the revised after tax earnings, revised profit after tax? Take 2-3 minutes and try to attempt it on your own. You need to take 2-3 minutes to try and attempt this part B. Okay. Um, no, basically, ideally, yes, the examiner is asking for an impact. So for impact, you need to calculate that what it is right now and what it is going to be. So let's actually talk about it. Um, this is current, then first director, and then second director. Okay, so what have been the changes? When we talk about the first director's proposal, there is actually a disposal of repair and maintenance segment. So the non-current assets can be sold for after-tax profit of 15%. So profit on sale of non-current assets, and that is actually we had non-current assets of 280,000, of which 30% were sold, and on those 30%, 15% after-tax profit was obtained. So it's actually 280 into 0.3 into 0.15. Gives you 12,600. Then what else do we have? The repayment of the loan. So you would have interest saved. The interest that you are actually going to save is you're going to repay 80% of the debt. So the debt was actually 120,000 into 6.2% into 80% multiplied by after tax. So for that you need to do it 0.8 again. So it's 120,000 into 0.8 into 0.8 into 0.062. So that is 4761 or what? 4761 or 62. So that's actually interest saved. Now, so that's going to happen in the first director's proposal. For the second director's proposal, it's actually about the risk diversification. In the second director, he says that the additional funds using debt finance then create a new SBU, etc., etc. So if we talk about the second director's proposal, he is suggesting that we should invest 70 million in non-current assets. And you do know the non-current asset, in fact, for both the first and the second director, the question actually tells us that in case if you deploy new non-current assets, or in case if you withdraw any new non-current asset, there is a 9% after-tax return on investment in the non-current assets. So basically, non-current assets would lead to impact on earning. In the first director's case, it's going to be 280,000 into 30% into 9%. So it's 7560. Now, for the second director's proposal, we need to actually invest new 70 million. So the 70,000 would be invested and they would yield a return of 9%. So how much is it going to be? 70,000 into 9%. It's going to be 6,300. And the extra interest that you would have to pay is 70 million into 6.2% into 0.8. So it's actually going to be 3,472, which is the extra interest that we would have to pay. And so can you please calculate how much is the earnings going to be? That's why we are taking after tax interest. Iman, your question is that do I need to compute changes in earnings from current position? Yes, you calculate the total earning, then automatically the changes would arise. Thirty-seven eight zero two and 30828. 37802 and 30828. So that's how actually so you have got the revised earnings. So we need to actually compare it with the original earnings. So we'll get the difference. We'll get the difference. Now let's move forward and let's discuss further. So we've actually gone through the second requirement, the third requirement also. And it says that forecast financial position. So I'm actually not gonna spend time onto that because that's gonna take a lot of time. It says discusses the impact on Murada of the changes proposed by first and the second director and recommend whether or not either proposal should be accepted. The discussion should include an explanation of the assumptions made in estimates number 1 and estimates number 2. Now the question's requirement is actually you need to discuss the impact on Murada company of the changes proposed by the first and second directors and recommend on whether or not either proposal should be accepted or not. The discussion should include an explanation of any assumptions made in the estimates. So now, yes, Nakul Agrawal, I'm actually going to discuss this. That how exactly do you need to actually go through the this discursive portion. Okay, now, so basically what happens is that what is actually happening. So what you actually need to do is that when we talk about the discussion, the examiner's requirement is discuss the impact of the changes proposed. Now, so what you actually need to do is that these changes that have been proposed, what impact are they having? They're having impact. These changes are having impact on what? They're having impact on your KE. They're having impact on your business risk. They're having impact on your financial risk. They're having impact on your WACC. They are having impact on your earnings, and they are having impact on your um, they're having impact on the earnings also, and another impact that is actually taking place on your balance sheet. Now, whenever the question actually says that discuss the impact, so you see what happens is you have got a lot of, I mean, this type of discursive question where you actually you actually perform the discussion as part of one of the question. It's relatively easier to attempt as compared to an altogether fresh discursive question. Now, why is it easy? Because what you can actually do is that you could talk in this way, that the company, that the existing KE was, let's say, 12%, and the first director's proposal would lead to a KE of 11.66%. The second director's proposal will lead to a KE of 12.27%. Now, you could actually talk about it that, and you can also compare the WACC that it is, uh, you can also compare the WACC that it is 10% right now. That is 10% right now, and it is expected to be 9.8% here, and is expected to be what? What is the? Am I doing it right? What were the values of the WACC in three of the cases? What was it earlier? What was it earlier? 10%? So the original WACC was 10%, then it got revised to 10. Okay, so you could actually, I mean, you see that such sort of a discussion, what you do is that the numbers are already there. You have already performed the calculations. All that you have to do is that you have to actually explain those calculations further. And you need to see that the cost of equity is, I mean, you compare that this is what the cost of equity was, this is how the cost of equity would be in the second director as in the first director's proposal, and then you actually compare that why is there an impact on the cost of equity, what has been the reason behind that. Then you need to actually talk about the weighted average cost of capital, that this is what the WACC was, then it turned out to be this in first director's proposal. then this turned out to be that in the second director's proposal, and what exactly is the difference between them. So you need to actually talk on those things, that why is this happening. And then you need to talk about that the earnings are increasing in the first director's proposal and they are actually having a nominal increase in the second director's proposal. Why is that so? Because in the first director's proposal, what is actually happening is it's actually the profit on disposal of non-current asset that's causing the actual gain. Had there been no profit on disposal, then it would not have been that much of a gain. Instead, it would have been a loss-making thing. And in the second director's proposal, the business investment in the non-current asset is enhancing the business earning. So you need to actually just evaluate. You need to just debrief what is actually going on. So the discursive portion is quite easy. If you go through the examiner answer is a very comprehensive and a very ideal situation answer. But my suggestion is going to be, what you should do is that you should break down that what is happening and why is it happening. When we discuss what is happening, why is it happening, and the last question is it good or is it bad? What is happening? Why is it happening? Is it good or is it bad? Okay, now next. It says discuss the possible reasons for the third director's proposal that a risk management should consider each risk before taking appropriate action. So let's actually talk about this third director's proposal. He says the third director is of the opinion that Morada does not need to undertake proposals suggested of first and second just to reduce companies. She feels that the above proposals require a fundamental change in corporate strategy and considered in terms of more than just tools to manage risk. Instead, she proposes a risk management system should be set up to appraise current risk profile, considering each type of business risk and the financial risk within the company and taking appropriate actions to manage the risk where it is to manage the risk wherever it is deemed necessary. So now what do we need to do actually? We need to actually talk about that they are giving the third director's suggestion is the risk management process should be implemented. You see, what is the risk management? Risk management is actually about identification of the risk, evaluating the significance of those risks, and then actually evaluating the likelihood. You need to identify the risk, then you need to assess significance, evaluate likelihood of occurrence. This is what you need to do. So basically you need to explain that obviously the company, if the company goes for repayment of debt by selling off a business segment, it's something that needs a proper evaluation. Similarly, if the company goes for a new business, then it properly needs an evaluation. All the factors need to be considered, which is the socio risk, the economic risk, the political risk, the other risk, which is the complete application of the pestle. So that needs to be implemented. So if the company needs to implement a risk management system, that's a better approach, because the risk management system would specifically identify the risks that are prevalent in the existing setup of the company, rather than going for new businesses with about whom which we may not know. We already know about what we are doing, and the new businesses we may not actually know that what those new businesses would be. So it's always better that we go for it's actually going to be implementation of the risk management system would help you identify that what the risks are rather than jumping into the new type of a business. Okay, so that's it for this question. We are done with this question. Now let's come on to few areas. Let's actually conclude the session. I hope that you people have actually received the WhatsApp link. So you could probably join onto the WhatsApp and you can actually discuss your queries over there also. Now, one thing which actually I would want to highlight is, you see the syllabus of P4 has got four major areas. And what are those four major areas? That's mergers and acquisition, that's restructuring, the investment appraisal, and the risk management. So these are the four areas that the P4 syllabus is. These are the four major areas. So my suggestion to you people is going to be that how to actually prepare for the exam. The best way to prepare for the exam is the exam practice question. So my suggestion to you people is going to be that you should do maximum question number 1, which is at least last 8 attempts. At least last 8 attempts question 1. Similarly, question 2, question 3, question 4. So at least if you do question 1 at least, and then you actually go through question 2, 3, 4, because the biggest problem, the biggest reason for the student failing the exam is that they don't handle question 1 properly. Question 1 generally have got 23 marks of the computation, and the remaining is all theory. It's all discussion. And the major discussion that is there in question number 1, around 15 to 20 mark discussion, is majorly focusing um, upon the numerical part that you have attempted. It's only the last 7-8 marks is there for the not pertaining to the numerical calculation. So my suggestion to you people is going to be that discussion, don't be actually scared of the discussions. You need to discuss and keep it very simple. Majority of the cases, it's actually the discussion of the calculations that you perform. So for you to actually succeed at P4, it is important that you understand that only 50% or 45% of the paper is going to be computational. And there's going to be around 30 marks pertaining to the explanation of those computations. So that makes it around 75% or 80%. And it's only just 20% of the paper that is not pertaining to the calculation. So you should be good at calculation. You should be good at explaining why have you performed, or what calculations have you performed, and what are they indicating. So it will become very easy for you. And the suggestion is going to be that you can actually go through the maximum theoretical portions from the revision kits or the past papers, because usually the students don't have access to the notes. So if you don't have access to the notes, especially trying somebody else's notes, especially when you have not studied from that tutor for the rest of the period, it becomes very difficult to actually adapt to those notes. So my suggestion is going to be that examiners answers and the question and the revision kit are going to be the best approaches to actually handle these issues. So that's it from my side. Our administration team would actually want to know your feedback. So we would highly appreciate if you could share your feedback, and with respect to any questions from me, you can actually go on and you can ask in the WhatsApp group that you are already added to. If you're not added to, the admin team has actually pasted the WhatsApp group here in the chat window, and you can pick out the link from there. So would appreciate if you could actually share your feedback to the today's session and the overall session. Thank you, Ruth, for your comment. Thank you, Nakul Agrawal. And Rabiba Rafiq, for the marking scheme, I would send across a few things on the WhatsApp group, hopefully, inshallah, today. Thank you, Iman. Thank you, Iman Hamdan Ali. Thank you for your comment. Thank you, Muhammad Azim. Yes, Mother Abbas, you can access the recordings. And thank you for your comment. Yes, Nakul Agrawal, that is going to be fine. Thank you, Rabiba Rafiq. I think it's not that difficult to actually pronounce your name. Probably people might actually be calling you Rabia or something like that. But anyways, yeah, that's how the discursive question is, that what is happening, why is it happening, and is it good or is it bad? That's how you need to actually tackle any discursive question, because discussion is actually both sides of the story. Okay, if anyone else would like to give their feedback, so please share it. And we're gonna end this session in 2 minutes time. So would highly appreciate if you haven't commented up till now. So if you could actually give a comment, and it's actually all being taken very positively. So whatever sort of comments that you have, you're satisfied, you're not satisfied, whatsoever the case is, you can share your comments very openly. Okay. Um, so thank you all for your time. Thanks a lot for attending this session, and we hope that you all will be able to pass in the session. I'll be available over the WhatsApp group in case if any one of you has any queries. I would try and actually answer them at least once a day. So thank you so much, everybody. Thank you very much.